right, let's dive into this deep dive on Coolabah Capital Investments.
Sounds good.
We've got a whole bunch of YouTube videos here with Christopher Joy, who's their founder, and some really in-depth looks at their investment strategies.
Interesting stuff.
And I know you're really keen to learn about how they make fixed income, well, a bit less fixed.
Absolutely.
And to be honest, who isn't, right?
Yeah, for sure.
So, get this. They're actually aiming for win rates of 80% or higher by actively trading bonds.
Really?
Sometimes multiple times per day.
Wow. That's pretty different from your typical buy and hold approach to bonds.
Yeah, definitely not your grandma's bond strategy.
No kidding.
So let's unpack this a little bit. What's the secret sauce? What makes Coolabah so different?
They have this thing, they call it quantamental.
Quantamental.
It's like, this fusion of quantitative analysis and good old-fashioned fundamental research.
Oh, okay.
So imagine like 60 to 80 proprietary models.
Wow.
Scanning for mispriced bonds globally. But it's not just algorithms, right? They have a whole team of credit analysts. These guys are like dissecting each issuer's fundamentals, making sure the numbers actually make sense.
So they're not just chasing like blips on a screen.
No.
They're making sure those blips represent real opportunities.
Exactly.
Gotcha. Okay, so how is the fixed income market so inefficient that this kind of strategy can work?
Right.
Because, I mean, the bonds are supposed to be this safe, stable asset class.
Well, you'd think so, right.
Yeah.
But the thing is, the over-the-counter bond market, it's surprisingly opaque.
Oh,
It's global. Trades often happen in large blocks. And price information, it's not always public or readily available.
Right.
And even when it is, it can be delayed or incomplete.
So there are these little pockets of hidden value waiting to be discovered.
Exactly. And that's where Coolabah comes in.
Okay.
Their models and their research, it kind of helps them shed light on these dark corners, identifying mispriced bonds and then capitalizing on them.
Okay, so they found these mispriced bonds. What do they do next?
Right.
Are they holding them to maturity like a traditional bond investor?
Not at all. Their holding periods are incredibly short, often just days.
Really?
They buy the mispriced bonds.
Okay.
They bet that the market will recognize their true value and then sell them for a profit.
So instead of riding the market wave, they're actively seeking to create their own ways.
Yeah, exactly.
To generate alpha.
Precisely.
But for those of us who haven't spent years on Wall Street, can you break down what alpha really means in this context?
Sure. Alpha is essentially the measure of a portfolio's performance above and beyond the market benchmark. It's the return you get not from simply being in the market, but from actively making smart decisions.
Okay.
That's the key.
So Coolabah isn't just trying to match the market, they're actively trying to beat it.
Absolutely.
Which leads me to the mastermind behind this approach, Christopher Joy.
Right.
His background seems anything but ordinary for a bond trader.
Yeah, he's definitely not your average bond guy.
Yeah.
We're talking Goldman Sachs, Reserve Bank of Australia, a PhD from Cambridge.
Wow.
He's even advised governments, including the Obama administration, during financial crises.
So he's the guy you call when the financial system is on the verge of collapse.
Pretty much, yeah.
That's some serious credibility.
Absolutely.
So, I mean, it seems like that diverse background is woven into Coolabah's DNA.
I think so.
They're not afraid to think differently and challenge conventional wisdom.
It's a good point.
So it's like they've got this unique blend of academic rigor and real-world crisis management experience.
Yeah.
Does Joy's background specifically influence their strategies?
I think it does.
What kinds of bonds are they focusing on?
They prioritize liquidity and high-grade bonds.
Okay.
So think, government-guaranteed issuers or those with minimal default risk.
So less risk, but they're still aiming for those impressive returns.
Exactly. That's why they don't blindly diversify or hold bonds to maturity like some traditional managers.
Right.
They need that flexibility to adapt to changing market conditions.
Right.
And seize those fleeting opportunities.
So it's like they're constantly on the move, scanning the market, finding the undervalued assets, and then getting out quickly.
Yeah.
But wouldn't that kind of active trading increase their vulnerability during times of market stress?
It's a good question.
Like, in 2008 or 2020 when everyone was scrambling for safety and liquidity.
You're right. Yeah, it's a valid concern.
Yeah.
However, that focus on liquidity, especially on high-grade bonds, actually help them during those crises.
Really?
When markets freak out, People want safety and liquidity.
Right.
And that's precisely what Coolabah had in spades.
So they weren't stuck holding a bunch of illiquid assets that suddenly lost value.
Exactly.
It seems like their active approach might actually be an advantage in those situations.
Yeah.
You could say that.
Okay, let's get specific.
Right.
What are some of the actual strategies they use?
Let's take a look at a couple of their key approaches. First up is the active composite bond strategy.
Okay. Yeah. It's designed for investors who want exposure to a diversified portfolio of high-quality bonds, but with the added benefit of Coolabah's active management style.
So it's like a core bond holding, but with a turbocharged engine under the hood.
That's a great analogy.
What makes it different from just passively tracking a bond index?
They're targeting a similar duration to the Bloomberg Global Aggregate Corporate Index,
Okay.
which, by the way, is a widely recognized benchmark for global investment-grade corporate bonds.
Right.
This means you get a comparable level of interest rate risk to a standard bond index fund.
So no wild swings in value if interest rates jump around.
Right. They're leaving the big interest rate bets to others. But here's where it gets interesting.
Oh.
On top of that stable base, you get their active alpha engine at work.
I like the sound of that.
They're constantly buying and selling bonds within the portfolio, aiming to exploit those mispricings and generate excess returns beyond the benchmark.
So it's like they're taking the core bond concept and adding a layer of strategic maneuvering to potentially squeeze out more returns.
Yeah. That's the active composite bond strategy. What else is in their playbook?
Well, for those who are comfortable with a bit more risk and are looking for higher potential returns, there's the Coolabah Floating Rate High Yield Fund.
High yield. That sounds a bit more adventurous. What's the story there?
This fund focuses on floating rate bonds, mainly issued by Australian banks.
Okay.
These bonds pay a variable interest rate that adjusts based on market rates.
So if interest rates rise, the yield on the fund goes up too.
Exactly.
That could be a good hedge against inflation.
You got it. And since they're focusing on higher quality issuers, primarily those big four Australian banks, the default risk is relatively low.
Okay, so less chance of those bonds going belly up.
Right.
But you said high yield, so what kind of returns are we talking about here?
As of our latest data, this fund was boasting a cash running yield of almost 9%.
9%.
That's a pretty attractive number compared to your typical fixed income investments.
A 9% yield certainly catches my attention.
But with higher potential returns, there's usually higher risk, right?
That's usually the case.
Is this strategy significantly riskier than the active composite bond strategy?
Well, there is more potential for volatility with this one.
Okay.
Remember, those floating rates can go down as well as up.
Right.
And although those big banks are considered pretty safe, there's always some risk, however small, that a bond could default.
Right. No investment is completely risk-free, but it sounds like they're trying to strike that balance between risk and return with this floating rate strategy.
I think so.
They're not just chasing the highest yield possible. They're focusing on quality issuers.
Precise. Now, we've talked about their strategies, but how can we be sure they're actually delivering on their promises? Can they back up their claims with hard numbers?
That's the million-dollar question. What does their track record actually look like?
Well, their track record is quite impressive.
Okay.
They've consistently outperformed benchmarks, delivered consistent positive returns, and achieved those remarkable hit rates we mentioned earlier.
But what do those impressive numbers actually mean for an investor? How do they translate to tangible benefits?
It's not just about the raw returns. It's about risk-adjusted returns. And Coolabah excels in that area too.
Okay, break that down for me. What exactly are risk-adjusted returns and why should I care?
One common way to measure risk-adjusted returns is the Sharpe ratio.
Okay.
It tells you how much return you're getting for each unit of risk you're taking.
So a higher Sharpe ratio means you're getting more bang for your buck, so to speak.
That's a good way to put it. And Coolabah consistently boasts high Sharpe ratios across their strategies. This indicates they're delivering strong returns without taking excessive risks.
That sounds like a winning formula. Are there any other metrics we should be considering?
Another key metric is the Sortino ratio,
Sortino.
which focuses on downside volatility. It measures how much your portfolio is likely to drop during tough market conditions.
So it tells you how much pain you might feel when things go south.
Yeah, and a higher Sortino ratio suggests you're less likely to experience those stomach-churning drops.
So Coolabah scores well on both Sharpe and Sortino ratios.
They do.
It seems like they're making money and doing it relatively safely, which is pretty rare in the investing world. Most of the time, it seems like you have to choose between high returns with high risk or lower returns with lower risk.
You've hit the nail on the head. Coolabah seems to be challenging that traditional trade-off They're offering something truly unique, a way to potentially capture those high returns without taking on an excessive amount of risk.
Okay. Their approach is compelling, their track record is impressive, and they're led by someone who's navigated some of the biggest financial storms in recent history. But their heavy reliance on quantitative models makes me a bit uneasy. What happens if those models miss something or if the market does something completely unexpected?
That's a valid concern. Models are based on historical data and assumptions, and if those assumptions are wrong, the models will be wrong too. But that's where their quantamental approach shines.
So those models aren't just running on autopilot.
No, not at all.
There's a human element involved as well.
Absolutely. Their fundamental analysts play a critical role.
Okay.
They're like challenging the models.
Right.
They dig deeper into the data and make sure the numbers make sense in the context of real-world economic conditions.
So they're not just blindly following the algorithms.
Right. Yeah.
They're using those models as a starting point,
Right.
but then applying their expertise to interpret the data
Yeah.
and make informed decisions. That makes me feel a bit better about the whole model-driven approach.
It's a powerful combination.
Yeah.
The models provide those initial signals.
Yeah.
But the humans add that crucial layer of understanding and critical thinking.
So it's a blend of quantitative analysis and human judgment.
Exactly.
It seems like Coolabah is really trying to find that sweet spot between data-driven insights and human experience. So what does this all mean for you, our listener?
Right.
If you're intrigued by Coolabah's approach,
Yeah.
if you're looking for a fixed income manager who's doing things differently, where should you go from here?
Well, it's definitely worth exploring further. Their track record is impressive.
Yeah.
Their strategies are unique.
Uh-huh.
And their leadership has a depth of experience that's hard to find. But as with any investment, it's crucial to do your own research.
Right.
And understand the potential risks as well as the rewards.
Absolutely. We've given you a glimpse into how Coolabah operates.
Right.
But there's always more to uncover.
Of course.
We've laid the groundwork,
Yeah.
highlighted the key points, and hopefully sparked your curiosity.
That's the goal.
Now it's up to you to decide if Coolabah Capital Investments aligns with your investment goals and risk tolerance.
Makes sense.
And remember, this deep dive was curated just for you.
Based on your interest in Coolabah and your desire to explore the world of active fixed income investing.
We hope you found it valuable. Until next time, happy investing.